Okay, let's do some Q&A from the last market outlook. And like last week, we'll start with the Discord comments. First one, I'd be at least neutral, if not short US duration at this point. If Trump's tariff announcement on Wednesday comes in soft, expect risk assets to rally and rates to increase. So you're expecting beta to do well, duration to do poorly. I don't disagree with that. If again with the if statement, if it comes in soft, if tariffs are extensive, expect growth expectations to plummet. I agree with that. Beta would drop. And inflation expectations to rise. That's probably true. How will the Fed react to such a stagflationary impulse? They've already given an indication of how they're looking at this. Tariffs, the effect here, that big word, transitory. I think that they would run to the other side of their dual mandate. You have full employment and you have price stability. I think full employment would win out here. I don't believe the Fed will see through tariff and call inflation transitory. Well, given how well that worked last time, Fed would be cautious. Additionally, the backdrop of reshoring U.S. jobs while simultaneously deporting the very people who would work in such jobs will tighten the job market again. I'm not sure that the illegal immigration, that the individuals that we would call illegal immigrants are taking union jobs. Keeping unemployment low, giving the Fed no incentive to lower rates. But I see what you're saying is you're just tightening an already tight labor market. There is, if you look at the gap between U6 and U3, which is the unemployment reported and unemployment, assuming that we count all the discouraged workers who are no longer counted as unemployed because they're not actively looking for a job. If we use that as the unemployment rate, we don't really have a tight labor market if there were alternatives. You could always make that argument as well, right? Absent a large disruption, I don't think U.S. duration will do well. I kind of disagree on that. Well, I'm kind of have to disagree. I've got such a large duration position. But I have a large duration position because I do believe it's going to work out. And it also is a nice ballast against the equity position. It has been performing well lately, even with elevated PCE, even with inflation expectations increasing within the PMIs. It has been doing well because the belief is that these policies will cause an economic downturn in the U.S., which will cause an economic downturn globally. And if you can't count on U.S. fiscal support in this recession, it's going to be a long, deep recession. The Fed will have to do all the heavy lifting. What I don't understand is that the U.S. imposes tariffs to bring back production in their own country and want to be more restrictive on immigration. Countries are already close to structural unemployment level. Even if companies bring back all the production to the U.S., where do you find all the people to do the work? That is true. Again, the difference between U6 and U3 might highlight something. My experience buying a car is different than what Mark described. My dealership would not give me a discount if I paid cash. That really depends on the 0% financing, right? If they're offering you a below market interest rate, that means the price of the car is above market, or at least above where they would price it if you don't need the subsidy from their lower rate because you are paying for the subsidy. So it's not just any old vehicle on the lot. If they're not offering you any financing, any preferable financing, then probably not. And with the administration focused on bringing manufacturing back to the U.S., could the utility sector stand to benefit from the resulting uptick in industrial energy consumption? Sure. The other side of the argument is you have this idea that tariffs are going to bring manufacturing back. That's the good story. That's not the unintended consequence. What could also perfectly legitimately happen is that tariffs cause the U.S. to go into a recession. And in a recession, companies aren't expanding because demand just simply deteriorates. So most of those investments that were announced would just get delayed. An announcement is not a commitment, it's just an announcement. So you could make the argument that everything is going to work out exactly as the administration says. We're going to put tariffs in. Companies are going to set up shop in the U.S. There's going to be a shortage of labor. The utility sector will do very well, and everything's just going to work out. More than likely, it will cause a recession, and in a recession, companies don't really get aggressive on their capex. They cut back. They rationalize their workforce, meaning they lay people off. You go into a recession, and energy demand actually drops. Which one is it going to be? I would seem to think the recession before the expansion, that there'll be some level of destruction before you have some creation. From the research I did, the financing arm of the automaker offers the 0%. Correct. It's the financing arm of the automaker. In return, they offer loan origination fees to the dealer, rebates to the customer. This allowed you to haggle more because the dealer could theoretically pass some of the origination fee along to the customer. So the advice I always heard was to always take the financing and pay it off immediately. Anecdotally, this seems to hold true, but the process isn't transparent. That doesn't sound... No, that doesn't match the information I have. I'm not saying no, I'm just saying it doesn't sound... So basically you have the automaker, right? The automaker really just wants to sell cars, but most automakers have a captured finance firm, like GMAC. For autos, you have General Motors finances its own vehicles. The finance arm needs financing, so it usually sells bonds at, let's say, it uses the auto company's credit rating, so it'll go out as investment grade, might get 6% on these bonds, maybe 6.5% on these bonds, and then it will offer financing at the dealership to try to sell vehicles. And of course, there's a credit rating that the person has to pass, and may offer something like 8% or 8.5% to finance the vehicle, where a bank might be 10 or higher. So they do have an advantage in financing because they can use their credit rating to get lower financing to help finance over here, and they make the spread. If they offer 0%, what they do is they raise the price of the vehicle, because they still have to sell these bonds out at 6.5%. So they still have a cost of financing. It's not free financing. It's not as if there's just money sitting around and that's what they use. They don't. So the price of the vehicle is increased by the present value of all of the interest payments. That if you went to the dealership that was offering 0% financing, and you said, I don't need your 0% financing, there is a lower price that is just a cash price, because all of this is no longer needed. The automaker gets its money. So you can, if there is an offer for 0% financing or 1% financing, any below market financing rate, the price of the vehicle is increased by the present value of all those interest payments. There is nothing free out there. There is nothing free. You are paying for it. If I had to bet, I'd say Trump will go ballistic on April 2nd. He wants to please his crowd and he wants to lower rates. If the market goes down, he will blame Powell for not cutting and Biden for leaving the U.S. economy in a mess. Well, that's what he would do with anything. Anything that doesn't work out is obviously somebody else's fault. It's certainly not his fault, right? It's obviously somebody else's fault. If it works out, well, it's him. It's his policies. He did it. So I mean, he would do that no matter what he was doing. If he were making toast and he burnt the toast, it's the maker of the toaster. It must be left-wing radicals that made the toaster. Probably either under the Obama administration or under the Biden administration. Never would have happened if he were president. A toaster that burns toast never would have happened. I mean, you could do it with anything. That's his modus operandi. He doesn't do anything wrong. No bad outcome is his fault. It's other people's fault. Next couple of years, if U.S. equity market goes up, he says he's fixed America. His first year was bad because he had to clean all the damage from previous administrations. Yeah, that's just a description of Trump. I don't know that it's particular to this situation as much as it's just a description of the man. Wonder if rolling back some of the dealer franchise laws and allowing automakers to sell direct to consumers could help shed some of the pricing inefficiency. Yes, it could. Yes, it could. I agree with that. I don't know what the purpose of the dealership is, other than just another place to add margin to the vehicle, because now you have to support all the infrastructure there. I think if you had just showrooms, scaled down showrooms with test models that you could drive and go to a Dell system where you order your vehicle and it is made when you order it. This is the production of vehicles is at a rapid enough pace that it doesn't take 3 months to get that done. I think that would bring a lot more efficiency into the system and lower the price of a vehicle if you can shorten the distribution channel. So if you think about the production to the consumer, the longer that channel is, the more you have to add margin at each place along the way. If you can go direct to consumer, the consumer does pay a lower price, but you do eliminate a lot of capital in use and a lot of employment. And all of these markups is the return to capital and labor in each of these places. Sometimes some things look like just a make-work project just so that everybody can get their beak wet, right? And that's something like this. That's sort of what it looks like to me. Would it be possible to increase deadweight loss and then pass the bill to the future with government debt and then inflate the debt away, keeping artificially low car prices? Or is this only theoretically possible? Well, the first sentence is what happens all the time with everything. As far as inflating the debt away, you need a surplus or at least a balanced budget to inflate the debt away. You can't inflate the debt away with a deficit. You can only add to the debt at an inflationary rate, which is worse. If you have a budget deficit and you do have to spend more than you bring in, you would prefer deflation in that sense. Well, I don't know if you'd prefer deflation. Actually, let me reverse that. You'd prefer zero inflation, I think, because it wouldn't expand the budget deficit that much. If you have inflation and you're promoting inflation, everything you're paying for gets more expensive. Your budget deficit would get worse. Just so that you understand what inflating the debt means. Let's say you have nominal GDP of around 30 trillion. And let's say the tax haul on that, it runs about 17%, which is about right. Once you get much above 20%, things get pretty bad because you start chasing capital away. But let's say it's 17%. Your revenue is $5.1 trillion, 17% of 30 trillion, because this is GDP. We have the equation GDP equals GDI, gross domestic income, and if you tax it at multiple rates, the average of everything being 17%, you'll raise 5.1 trillion. how you inflate the debt is you let inflation run hot. So let's say that real GDP you think can run about 2.5%, and you have inflation which you think can run about 2%. You would have 4.5% growth in nominal GDP, which means your tax revenue would also grow by 4.5%. If you let inflation run hot, let's say you let it run to 4%, let's say 4.5%, so we have a round number, you'll get to 7% nominal growth. And if you get to 7% nominal growth, your tax revenue will increase by 7% from 5.1 trillion, increase by 7% without raising any tax rates, only because everyone's making 7% more. You take that 7% and you pay down the debt, but you need to run a balanced budget to do it, such that when you let inflation heat up, it raises tax revenue, but you haven't spent a penny more. That's not what's going on right now. So you can inflate away the debt, but you must first get to a balanced budget and then let inflation run high so that tax revenues increase basically at the rate of nominal GDP. And if inflation is running high in nominal GDP, you can even have zero real GDP if you're going to let inflation run at 9%. You'll have 9% nominal GDP growth. Tax revenues would be 9%. You can pay down that debt rather quickly, but you must have a balanced budget. Also, yes, 0% APR is a scam, but so is paying full in cash. Okay. I don't know how paying full in cash is a scam. Let's find out. Shopping the market 2023 for a low kilometer QX60 found most dealerships GTA post on Auto Trader websites, etc. a lower price, assuming some sort of financing arrangement. If you say you want to pay full in cash, I found generally they would raise the price between two. So if you went to a dealership and said, I need you to finance this for me, they'd give you a lower price. But if you said, look, I'm willing to pay cash, it's cash. Oh, we don't want that. Sorry, the prices, you're going to pay more if you. That doesn't make any sense to me. Do you mean the other way around? Buying a car with most of it down and the smallest possible financing would snag the car for cheaper than paying full in cash. I have no idea what that means. I have never experienced a situation where if I went somewhere and said, can you finance it for 30 days? And if they said yes, I said, oh, hang on, I have the cash in. They said, oh, well, you're just going to have to pay more if you're going to pay today. I've never had that situation ever in my life. It's cash is king. You'll always get a lower price by saying, I don't need any of your financing. You'll have the money in your bank account today. When I say cash, I don't mean a suitcase full of cash. I mean you don't need any of their services. If you pre-arrange a loan at a bank and go buy a vehicle, that's paying cash for the vehicle as far as the dealership is concerned. I've never seen that before. More about RRP and reserves. How to use it to analyze the market? I don't really use it to analyze the market. It is more a gauge of when the Fed will stop its balance sheet runoff, because it wants to work in an ample reserves regime. And that means it wants to stay on the flat part of the curve. So if we think about the level of reserves and we think about an interest rate, here is the demand for reserves. If you have reserves over here and you change rates, you're on the flat part of the curve. You get very little behavioral change going on. That's what they want. They don't want to get to this point where reserves begin to change, because if that happens, that money flows into the market, and it flows if it flows into money market securities, it will move the rates outside of the range the Fed sets. Where is this inflection point? They don't know. Nobody knows. This is called an ample reserves regime. and that's sort of where they want to stay. So once the reverse repo hits zero, that is saying that money market funds are finding enough money market securities that they don't need the Fed. And if there's money market securities out there, if there are ample money market securities out there, it will pay more than interest on reserves. So reserves will find its way into the money market as well. And then you'll start moving this way along the curve, and they don't know where it would begin to affect rates in the market. What is your current super high conviction list apart from duration? Telecom, I'd say, and well-run telecoms. AT&T has been a winner for quite some time now. What are we at, $28? It keeps hitting the 52-week high list. If you think the world will be more digital, more autonomous, more robotic going forward, you need a network, and you're not going to sneak up on AT&T. There's not going to be another network. It's too big of a footprint. It is almost a quasi-monopoly, really. It's what do you have, oligopoly in that sense, and I think the network just gets more valuable. If you are getting into a more digital world, you have to move bits and bytes around. That takes electricity, that takes energy. Anytime you need to move electrons from one place to another, that's copper. And gold still is got some good fundamental drivers to it. So they would be fairly high conviction over a period of time. Short USD over Trump's term at least. I don't see him as at least the path that he's on, and I say he, not the U.S., because it really comes down to one person's decision on a day-to-day basis what's going to happen to the country. I don't see, if he continues on this path and this direction, that's not the recipe for a strong country. He's isolationist. That is a recipe for a weak U.S. dollar, which would benefit the U.S. in terms of its trade deficit more than tariffs. So there's a good outcome there, but I see a weaker U.S. dollar. Those would be sort of where I am on high conviction. Opinion on moving towards EM equities as more free trade deals are announced between them. Well, I don't know. Let's take an emerging market. Let's take the U.S. and they were sending product to the U.S. and now there's going to be a tariff, so it just gets redirected to other countries in a trading zone. Is this trading zone creating more trade than existed before, or is it just absorbing the redirected trade? If it's just absorbing redirected trade, not really. I don't know that is increase in revenue as much as revenue from different places. The applied series on directional strategies compare buying one out-of-the-money call, rolling it every 6 days versus holding a 1-year in-the-money call. Don't remember that. You showed the 6-day rolling strategy could provide better ROI, but that comparison is based on different margin requirements. Well, there's no margin requirement if you're buying a call. The only margin requirement is you pay for the call. How can I buy call options in a way that maximizes delta optimally? I don't know what that means. In other words, what's the strike per maximum delta per dollar? Who cares? I guess is my answer. Tell me why you would care about that. If I buy in the money calls, the delta is higher, but so is the premium. So is the cost. Yeah. That means I can afford fewer in the money calls and more out of the money calls. Oh, I see what you're trying to say here. Where are you getting the most delta for the money that you spend? Oh, I don't know. Give me an options chain and a calculator, I can figure it out, but so can you. I mean, you're just dividing. I think you can figure that out. But I guess why is that important to you? All right, why is it important? You're only looking at one thing, delta. What if you found one option where you said, look at this, the delta per dollar is really high, but it had no gamma or so little gamma. And you had another one where the delta per dollar was lower, but it had very high gamma. Which one is going to increase the most for the same move, which is what you want. You want that delta to change. So you're focused on one thing. This is why I don't understand why does it matter? Since in the money calls of higher delta, down in the money total, it doesn't matter if it has. I think you're looking at the wrong thing, or being distracted by something that I think is probably not got a lot of meaning. I get the example. So gold has recently surged past 3,000. A lot of inflows in the physical gold ETFs, largely driven by the uncertainty around tariffs, especially with that guy's Liberation Day coming. How do you see the sustainability of gold safe haven appeal? Well, I don't think so much that it's just tariffs. If it's not tariffs, it's going to be something else. It's the withdrawal from international organizations. It's the attack on allies. It's the rhetoric about we're taking Greenland no matter what. We're just going to take Gaza. We're going to take the Panama Canal. Canada doesn't work as a country. It only works as a state. We're going to take it. Here, I'll even draw new lines on Canada to show that the border was arbitrary. It's all of that. It's not just tariffs. It's all of that that is making the U.S. Unreliable. And when you have an unreliable superpower, what you have is a more risky world, a geopolitically risky world, because if the U.S. is speaking like that, then so can China. We're going to take Taiwan, and so can Russia. We're going to take Ukraine, then we're going to take all the other countries back that we used to have. In his acceptance speech, not acceptance speech, but his inauguration speech, he said the U.S. will be an expansionist country again. Well, that's what China wants to be. That's what Russia wants to be. Why is it just a U.S. privilege to be expansionary? It gives them permission to be expansionary. So you are entering into a more politically dangerous world, and the U.S. has shown itself willing to use the dollar as a weapon. And crypto is... it's just not a serious thing. So gold is gold. Only gold is gold. So as long as that guy is there, gold has a reason to be owned. As long as that guy is there, and if it has a reason to be owned, it will go up. Trump is not a stabilizing force in this world. He is a destabilizing force. He is not a provider of certainty. He is a provider of uncertainty, destabilizing factor with an uncertain future, with an unreliable partner, with a leader who does not respect any deal that he enters. He doesn't hold true to his word. He'll just change it whenever he wants. This creates a need for a safe haven place. You can have U.S. treasuries, but again, what's he going to do there? Is he going to cancel all debt that's owed to foreigners? Is he going to use the treasury as a weapon and say, okay, well, the Chinese central bank is holding $1 trillion. We're just not going to pay. You're done. You're done. Either you do all of this for us, or we're just going to cancel this. Now, would you put that past him? Would you say, oh, that's a step too far? And if you wouldn't, if you would say, oh, I can see that being a possibility that he'll truth that out one night. Well, you can't be in treasuries. Gold, where else can you go? Gold, right? Because you're not bound to any country's policies any longer when you have gold. So how do I see the sustainability of gold safe haven appeal? It is as long as that guy is there, gold. As long as that guy is there. Do you think this trend will hold even if the tariff risk starts to ease? If tariff risk starts to ease, it'll be something else. It'll be something else. He wants to be a Caesar. It's going to be something else. It is going to be, and he is not a team player. So anything where the U.S. is a team member of, well, you got to go, because he's not a team player. So all of that will go for the simple reason that he's not going to sit at a round table. He either sits at the head of the table or he sits at no table. Period. So yeah, with sort of that in mind, I would seem to think that I'd continue to hold gold. And it even rhymes, so it must be true. Hold gold, right? Do you think at some point you could do a video discuss your model Trump? Curious of your thoughts and the actions he has done that may have changed your model. Doesn't change my model of Trump. What we have is an individual that, if you pay attention to, uses one tactic and has used one tactic his whole life. Threaten. If you have power, meaning you have a certain amount of wealth, you have a certain amount of money, you hold a certain office. If you have power, the threats can work. But he's not a negotiator. He doesn't get things done quietly behind the scenes. That's not his style, nor does he have the skill or ability to get that done. He's never had to rely on that. Threats always work. Choose your partners wisely. Make sure you choose weak partners, and then you threaten them. So he'll continue to negotiate that way because, well, that's all he knows how to do is I'm going to extract concessions out of you, and then I'm going to call myself a deal maker. I made a deal. But making a deal is getting you to give me what I want willingly, and for you to want to do that because there's benefit in it for you. My ability to get what I want is directly tied to my ability to demonstrate this is what you want as well. But if I just show up at your house with a couple of goons and a baseball bat and I say, you're going to wash my car, I'm going to break your freaking legs, I'm not a deal maker. I'm a thug. I've threatened you. I've bullied you. I can't go out and say, look at how good I am at negotiating. Well, any punk can negotiate that way. You give any punk power and watch what they do. Look what happened to the left when you gave the wokeists a bit of power. What did they do? They bullied you and threatened you. I mean, you either bowed down to their altar of ideology or you suffered badly. People lost their jobs by even questioning the ideology. That's not negotiating. That's not getting everybody on the same team. That is bullying and threatening. Trump is the same as the wokeists, just on the other side. I'm getting really tired of all the extremist politics. I don't know, why can't we just stop in the center? Most people are in the center. I don't know why we can't just stop there and say, look, here we are. But it's this echo, is that the further left they go, the further right the other side goes, and it's this big, wide swinging pendulum until it's going to break the side of the grandfather clock somewhere. But my model of him is very simple, is that he has one trick and only one trick. Now, when I look at his policies, and let's just think of some of them. Illegal immigration, shut that down. Yeah, I agree. You have laws. You have laws on how you can come into the country. You can't just pour across a border. Canada would have the same thing if people started pouring across this border. Any country would do the same thing. I agree. And if you're in the country illegally, you got to go. I agree. I absolutely agree with that. The trade deficit. The U.S. has had a trade deficit for a very long time. Is there something they can do to balance trade? There's nothing wrong with saying we would like to balance trade. I agree with that. No problem there. As far as bringing production back home, every country would love to do that. Would love to say, let's create jobs. So we can say production or job creation. Yeah, there's nothing wrong with that. So as far as the policies go, I agree with them. As far as the execution goes, this is rookie hour. I don't know if you could ask for worse execution to take a policy and execute it the way they're doing. It's like, oh my God, it's not the policy. It's the way you're executing it that is absolutely abysmal. You guys are the worst at execution. It's like you just don't know what you're doing, and you don't understand the subject matter of what you're attempting to change. This is not really my focus. This is the focus, is that he will mess it all up because he doesn't have execution ability. He never had execution ability. He got everywhere just by threatening and bullying. And I don't see that that is going to change. Now, again, I want to be clear. This is just the way I think about it so that I can decide what it is that I want to do. In my model, he is not playing 3D chess, and he is not doing a 4-bank side shot. Think about, now that I brought the reference up for a pool table, let's think about a break shot. You know, you have your pool cue over here and you break and the balls just scatter, right? One of them may sink. Would you then say, oh my God, what an amazing break, you got the ball in? Did everybody see that? You wouldn't say that. You'd say, well, maybe a ball will sink, maybe a ball won't sink, but if a ball sinks, it's just a function of the break. So if something in the U.S. happens where you say, oh, okay, well, at least that's a positive thing. That's just a ball sinking off a break shot. I would not attribute that to him and say that was the strategy all along, was to play this game of chicken with the economy to get this outcome. The probabilities of that happening are so slim. That if you're thinking, well, he's going to do this so that this will happen and those people will do this, and if they do that, then these things will happen, and that's exactly what he wants. Oh my God, the guy's a genius. No, he's not. He's not. The most he's doing is telling everyone to get the hell away from the pool table. He's the one that's going to break, and if he doesn't break, there's going to be trouble to pay, and he breaks, and maybe a ball sinks. But nobody else can play the game because he's holding the pool cue. You see where I'm going with that? It's if anything happens, it's unintended. So that is just basically my model. Any thoughts on Castellium at these levels? Where are they, like $10 or something? Options have nice premiums. IV at 55. Yeah, but French company, aluminum. No, I have, I think I got out of that I was playing it around 18, 17, 16. I think once we got to like the 15 level, I just got tired of seeing it underperform, and I just moved on. I have not looked back on it. Best in focusing on the 10-year, wouldn't that be a better place to be for duration exposure rather than longer duration TLT? Could we get a lower 10-year but steeper longer yield due to continued budget deficits? Well, yeah, the slope between the 10 and the 30 is never really that high. Even with steep yield curves, there's your money market rates. You'd have to have very low money market rates in a 2-year, the 10-year here. Even if you have something like this, it tends to flatten out quite a bit after the 10-year. The steepest would be the 2 to the 10. It tends to flatten out. In fact, I've done it sort of elevated. It tends to be more like this after the 10-year. So if you bring the 10-year down, this segment pretty much comes down with it. Because if I need a 10-year bond and the 30-year yield is that much higher, I'll buy the 30-year and sell it in 10 years, right? I'll create my own 10-year bond with it. So it would come down as well. Not only that, it's not just the 10-year. The 10-year might have a duration of about 7.2. The 30-year has a duration of around 16. So if you have a 100 basis point move on the 10-year, the 10-year bond price would increase by 7.2%. And let's say you only get half of that on the 30-year, that the 30-year only comes down 50, so that you have a steepening between the 10 and the 30. The 30-year would go up by 8% because 16% for a 100 basis point move is 8% for a 50 basis point would still outperform, even if it only gets half the move, because it has larger duration, higher sensitivity to changes in rates. At the end of the market outlook, you showed your supply and demand graph measuring value on the y-axis. Is money the best proxy for the economic concept of utility? No. If you're measuring utilities and money, then you're just measuring money. Utility is some satisfaction. It's a measure of satisfaction you get out of doing a certain action. So if an economist observes your purchasing behavior and you buy something or spend money in a way that the economist thinks, well, that's odd. Why would you take the more expensive, lower valued option? The economist would then rationalize that you must be getting some level of satisfaction by doing that. Whatever that satisfaction is, it must be maximizing your utility. However you measure utility is just some imaginary number, some imaginary concept. I don't like the idea of utility for two reasons. Number one, consumers don't go around measuring utility. Don't say, oh, I get more utility out of this than utility out of that. Number two, consumers, even if they're unaware of it, are not maximizing their utility or are not necessarily maximizing their utility. They might just be uninformed buyers making a stupid purchasing decision. Economics doesn't allow for that, but there's a lot of stupid purchasing decisions out there. So I don't like the concept of utility. Does the CFA go over holding companies? I'm doing a credit analysis of a holding company. It's my first time, so I was hoping there would be some academic official material for me to learn more about these types of companies. It touches on the idea of debt at the holding company versus debt at the subsidiary. It does touch on that. There are a couple of credit analysis readings, but not a lot. CFA is a generalist designation. For something like what you're looking at, you would want a more specialist designation or a more specialist body of knowledge. And CFA is a generalist body of knowledge, so you'll be familiar with the idea of debt at a holding company versus subsidiary. That's about it. I mean, it doesn't go into pages and pages on how you would begin to analyze that. Just sort of a general look. So you'll come across the word structural subordination, but that's about it. Fed is doing exactly what they said they would, acting based on the data they get. Honestly, there's not much out there that suggests inflation is going down anytime soon. In fact, consumer inflation expectations just rose 3.1 in February. Yeah, but that's just their expectation. What does the consumer know? Economists think inflation might even rise in 2025 due to tariffs and other factors. Yeah, I think that's a correct statement. Tariffs will raise prices for Americans. Tariffs will lower Americans' real purchasing power. So that instead of going to the mall, when you spend $1,000 and getting a certain amount of product, you'll go and you'll spend $1,000 and you'll come home with less. Or you'll just pay more for the same stuff. Tariffs will do that, yes. So as far as it being inflationary, I agree. The uncertainty isn't actually pushing prices up. And the Fed is just waiting to see what happens next. They're not moving in anticipation. They're waiting for the numbers to tell them what to do. I agree. Short-term bearish on the long end of the curve. Well, I wouldn't disagree. I wouldn't disagree with that. I think money market fund at 4% sounds reasonable to me now. True. TLT has struggled for a while. True. BlackRock, Morningstar, Morgan Stanley reported longer duration remains less appealing due to their sensitivity to interest rate changes. True. Long-term bond funds have historically underperformed during volatile periods, with investors often timing them poorly. Well, investors time everything poorly. I don't know that I'd pick on long duration as being the target of poor timing. There is no evidence that even professionals, there is no evidence that even professionals can time the market. So they typically don't. The biggest market timers are retail traders, and they usually end up doing very poorly. Once you conclude that you cannot time the market, that you have no skill in timing the market, you can take a lot of gambling out of your career. And then you can focus on, well, if I can't time the market, what can I do? You can then focus on other things rather than attempting to time the market. I have no skill at timing the market. I've said this before on my picks when I select things. I'm about 90% right on the things that I pick, but I'm about 90% wrong on my timing. So I try not to bring timing into the situation. That doesn't mean that I don't tactically position for certain events, but I try not to make trades based on what the price has been doing and attempting to time things, saying, oh, this has gone too far too fast, I'm going to sell it and then buy it at a lower price, and then I have no skill at timing the market. But no one has any skill at timing the market. I don't know that I'd lay that at the blame of just long duration. Okay, let's move to the YouTube comments. I got about, I think maybe, where are we now? April 2nd. Got about 8 weeks. Let's say 8, maybe 9 weeks left of the YouTube comments. And the only comments that'll be left are the Discord ones. So if you haven't got a free account on markmeldrum.com, get one now if you want to continue to leave comments. You'll still be able to watch the market outlook on YouTube, but it'll be shortened. So instead of a 1 hour market outlook, it'll be somewhere around 15 minutes. But the 1 hour version will be available on Discord. The longer version will be available on Discord. All this is free. A free account at markmeldrum.com. You will then be given sometime in mid-May some instructions on how to get to Discord with an invitation link, and it is by invitation. That's free as well. And the market outlook will be there, and you can leave your comments there. That's free. All of this is free. I'm not forcing anybody to give me any money on this. This is all free. I'm just trying to clean up the comment section and keep the bots out of there. I love how frustrated Mark gets when the three don't agree on earnings. Yeah, it seems like such an easy thing to get done. I must be missing something. I own a local wine store here in Denmark. I have not sold a single bottle of American wine since mid-February. Oof. I could lower the price by 50%. That would not change anything. It's an odd third dimension of the supply-demand relationship. Some decades ago, it was the French wine. France would not stop their nuclear tests, and people just stopped buying, letting Italian wine win their market share. I fear that this odd dimension is sticky and will hold American products out of Europe for a long time, no matter the prices. I agree with you. The undiplomatic manner in which this guy is approaching international trade, not just international trade either, just international diplomacy, the undiplomatic way that he's doing it has not gone unnoticed among the consumers of the world. We shouldn't notice our politicians, by the way. We really shouldn't notice them. It should be boring. But it hasn't gone unnoticed by the consumers of the world, which are already enacting their own version of a non-tariff trade barrier. We're just not going to buy the stuff. This is not just going on in your wine store. This is going on everywhere. It's nice to get some stories on this. Not nice, but I mean it's insightful to get them. Sticky and will hold American products out of Europe for a long time, no matter the prices. I agree. I'm not a fan at all. Trade is built on trust and at least some friendship. Yes, but that trust has been breached, and I don't know that Trump wants to be anybody's friend. Trump doesn't want friends. He wants followers. He wants acolytes. He doesn't want friends. He doesn't want to be a team player. Let's see. I'm not gonna read these. I think Mr. President will stop with his tariffs. Will not stop with his tariffs until there's a tangible proof that it doesn't work. That means billionaires screaming at him. Yeah, I think you're right. Things will have to break, but again, as I said earlier, if things break, it's not his fault. It's someone else's fault if things break. Not his fault. It's saboteurs. Where was the last time we heard stuff like that? The saboteurs. Discord value, great proposition. All right. Solid economics. What we also need to expand on is the overall effect that occurs in supply chains. Suppliers take months to years to establish, aggravated by natural and conflict interruptions. This one is going to fragment entire industries. I agree. You don't just reset these supply chains. You don't say, oh, okay, we'll just get it from somewhere else and then tomorrow you're up in business. It takes years to develop these supply chains, sometimes decades. Okay. Watching your managerial accounting playlist due to my course in university. So I like financial accounting, but I always find managerial one not so relevant in finance, especially cost recognition. ABC, that's activity-based costing. But now seeing you applying fixed costs, contribution margin, variable cost, break even, I was shocked that this can be a useful tool too. So just wondering how important accounting knowledge is to be able to analyze any investment opportunity, macroeconomic analysis, and which concept of managerial accounting is most useful. The CFA curriculum doesn't quite have any module based on that. Well, it does. It comes close to managerial accounting. If you look at the prereqs for economics, one is on the economics of the firm. Managerial accounting and economics of the firm have kind of a very large overlap. Managerial accounting will help you understand how firms make decisions, or at least the structure of the industry that would most likely result from the types of companies and the types of decisions they make. So you have some industries, like the auto industry that I just described, where understanding the cost of doing something will help you understand the distribution of production and how bringing small car production back to the US will only result in higher prices. There are no economic laws that suggest the price would drop, only that it would increase. How useful is it? I find it very useful. You don't need financial accounting to analyze statements like balance sheets, income statements, cash flow statements, but they certainly help you understand the transactions that then resulted in the account statements that you see. You have a better understanding of what those accounts were. A managerial accounting will help you understand the likely decisions a company will make because you understand how management makes decisions. By watching your market outlook regularly, I take you use a hybrid approach, top down and bottom up. But which one are you more inclined towards? It depends on what I'm doing. If I'm looking at a company, it's bottom up, but which company? You get there from a top-down approach. What do you expect out of the economy? What sector do you expect will do well from that sector? What sub-industry from that sub-industry? What company? So I think everyone uses a combination of the two. April 2nd is probably just the beginning. How do we realistically wrestle with the federal budget deficit? As you stated several episodes ago, 100s or 1 to 2 billion savings or cost cuts. What are the implications of not renewing the 2018 Tax Act on the economy? I don't even know that it's worth talking about that. It's going to happen. They will renew. It's Trump's signature policy from his first term. That is not ending. It'll continue on. So I don't even know that we would even spend a lot of time discussing, well, what would happen if the tax cuts didn't expire? They won't expire. They will be extended. can be modified, but you can't have it both ways, tax cuts and lower deficit. No, you can't. And it's going to get even worse this year. You have interest on car loans that they want to make tax deductible. You also have no tax on tips that they want to get into this bill. You also have no tax on overtime that they want to get into this. You also have no tax on Social Security. And you have policies that are tanking the market right now. So as far as 2025 is concerned, any cap gains tax that could be collected, you can take that out of the picture. You're handing people capital losses. You have tariffs, which are going to be inflationary in some industries and cause gluts in others. You're going to have job losses. You'll get job gains somewhere, but downstream you'll get more and more job losses. So if you have job losses, you're going to have lower income tax. All right, and if you have higher prices and lower demand, you'll also have lower tax on profits. So 2025 is looking like it's going to be a much lower tax revenue year than what they're forecasting. Tariffs aren't going to bring in nearly the amount of money that they claim because imports will simply just will just drop unless Americans just keep paying more for the same stuff. But it's going to bring in some money, but that's going to be offset by losses somewhere else. So the tax side, the revenue side, looks very suspect. Oh, we're going to have all this revenue. It's like, doesn't look like you're going to have that much revenue to me. It looks like you're working hard to try to eliminate all forms of revenue. And Doge, while you're hearing all of these great things, cuts on this, we found this, waste, fraud, and abuse, this, that, the other thing. All in all, if you look at initial claims, we're not really seeing much. Look at the budget deficit for the first quarter, I think was another record. So the spending doesn't seem to be going down, and certainly not going down by as much as what you would like, considering that the revenues are also going down. So that budget deficit that they think that they can clean up, that $2 trillion, wouldn't surprise me if it came in at 2.5 to 3 trillion in the first year. But that would be Biden's fault. That would be somebody else's fault, right? Dropping interest rates, that could do something. Not much, but something. Inflating out some of the debt. Again, to inflate away the debt, you're going to have to get to a balanced budget. But it has to stop growing first. That's true. Tariffs will barely cover the deficit. Tariffs won't cover anything. And it has unintended consequences. Interesting analysis of the car market and tariffs. Looking at CPI components since 2022, car insurance prices may well be an unintended consequences. If tariffs cause the price of vehicles to increase, the insurance is on the value of the vehicle. The insurance rates will go up as well. What's the benefit of being long SPY via synthetic long position versus just buying the ETF money? If I buy 20,000 shares, I'll need roughly $1 million US. Or I could just do 2,000 shares, sorry, 2,000 shares, 20,000 shares, 2,000 shares. Or I could do 20 synthetics, and it'll cost me zero. At least if I do them well enough, then I was able to get them at pretty much the same price, so it cost me zero. I didn't have to convert any Canadian to US dollars and then have Forex exposure. Here I have 1 million US. What if the US dollar weakens and you want to bring that back to Canadian? You could actually end up with a loss because the currency outweighed your gain. Whereas if I do it with a synthetic, I have no Forex exposure whatsoever. It seems too early to be bullish in the short, medium term, even if we will get some clarity. I'm not bullish, I'm bearish, but going into this event, I seem to think
that the risk is to the upside. What if these things come in softer than expectation? Even if you get tariffs, if they're lighter than expected, I seem to think you're going to get a rally, especially after this 10% sell-off. A lot of the selling has happened in anticipation of these tariffs. That I don't know that I'd want to go into them bearish. I think that you'd probably get some kind of bounce, some kind of relief rally, but that rally can be sold. Sitting at 556, 557 as I do this early Wednesday morning. If you get a rally to 565, 570, 575 range, I think that would be about it. I would be shorting. In fact, any kind of rally, I'm going to start selling 565 calls. If it continues rallying, I'll move to 570. I'll move to 575. But any rally on this, I would be selling it, only because that guy is still there, and it'll be something else. It'll be something else. Where do you get the forward PE for SPX? I get it right from FactSet. Slightly different at 20.5. It's because they use the forward earnings over the SPX as of Thursday night. I use the SPX as of Friday closing. So it's just 1 day difference. If Friday's closing was pretty much the same as Thursday's closing, our ratios would be the same. I'm glad I'm not the only one who wasn't absolutely baffled by TLT's reaction to PC on Friday. I really don't understand it. 10-year yield gap down even further on Monday. Any takes on what could possibly be going on? I think the shift in sentiment on the long end of the curve is reflecting the impending destruction of the U.S. economy if we continue on this path. If today you hear 20% tariffs across the board, then I would say short every U.S. equity you possibly can, because that's an economy killer. That will kill the U.S. economy. It'll kill other economies as well, but it is a U.S. killer. And duration will do very, very well. Short beta, long duration, I think you'll do very well if you get this 20% tariff across the board. But if you get something lighter, you will get a rally that should be sold, because this won't stop. Tariff man won't stop. He won't stop and say, it's not working out. No. So I think that everyone's focused now on this. He seems hell bent on creating a recession, which he isn't. He's hell bent on tariffs, which will create the recession, but he denies. No, we're going to bring jobs back to America. We're going to raise trillions of dollars in tariffs. How can you have both? Again, I thought if you jumped over into the U.S., there'd be no tariffs, but apparently you're still collecting that. Like, he says things just to say things. So he'll describe what winning looks like. Even if you don't get to that win, he'll still say that you won by describing all the good stuff, even if the good stuff is contradictory, that you can't have both those things, but yes, you can. And if we don't get both those things, it's because Biden messed it up. Or something Obama did. I don't have a background in finance and economics, but I've gained some elementary knowledge on economics after spending time following news and videos on YouTube. I've also gained basic knowledge of options to understand the strategies you were explaining today. I like the idea of managing my own money, but I don't want to go through formal CFA program. Plus, my core interest lies in mechanical engineering and design. Are your old level 1 videos 2018 good starting point? Yes, they are. I get what you're saying, that you want the knowledge that the CFA program has, but you just don't want to go through the program. Yeah, that's perfectly fine. The 2018 ones are good enough. Isn't it incorrect to compare S&P 500 PE to historical when weights of sectors have also changed? No. I don't think that's incorrect. If we're incorrect, you could never compare it to anything because you could always just claim, oh, you can't compare it to anything. If you're comparing it to 1975, then yeah, I can understand that. But if you're comparing it to 2015 or 2005, weights haven't changed, that much over that period of time that I would say no, 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 I wouldn't agree with that. Beginner, lots of podcasts and sites in Discord and in general available on the internet. Do I have to go through all of them? You don't have to do anything. No. What would you do, have done if you were a beginner? Well, when I was a beginner, I was looking for everything and anything. Right? I wanted to understand this game very deeply, so I did everything, even almost a year or a little more than a year with technical analysis, till you come to the conclusion that this stuff doesn't work. This stuff, flip a coin. This stuff doesn't work. As much as you keep trying to figure it out, you realize that it's just nonsense. But you must come to those conclusions on your own. You must take the journey on your own. I can't take you through a visual tour of another city and you fully understand the experience of that city. You must travel to that city and do it yourself. Yeah, you're going to spend a lot of time listening to a lot of things, reading a lot of things, investigating a lot of avenues. That's life. That's the only way you're going to get the experience, is if I leave you free to get the experience, which means both the good and the bad experiences. So what would I do as a beginner? Probably the same thing. What do you do with respect to podcasts and stuff since you are an expert now? Well, you say an expert. You can know 90% of something, of one thing. And you'll know 80% of a couple of other things, and then you'll know 70% of some other things, and you'll know 50% of a lot of things, and you'll know 20% of everything else. You can only really be an expert in one or two domains. You're never going to know it all. So there are some areas of finance of which I would say I probably only know 20%. I'm no expert at all in certain things. A lot of sectors in sector analysis. Do you want me to go through any sector I like, and after I complete, then pick a company in that sector? Yeah, that's what you would do. Yeah. Actively managing my portfolio since the end of 2020. Seems I'm doing very well. Learned how to calculate performance ratios in L2. And I've calculated a Sharpe ratio of 0.94 and information ratio of 0.61 against VT. Total World Stock Index. Oh, it's a big benchmark, don't you think? Using daily excess returns. Excess returns off of VT. Usually when we say excess return, it's usually off a risk-free rate. I've double-checked my calculations a couple of times and everything seemed correct, but I'm still having a hard time accepting it. This isn't a brag, but my understanding is that this is exceptional performance. It is. However, it's a short time period and the market has been peculiar. I would have to look at what it is that you're doing. The Vanguard's Total World Stock Index is a long only ETF. Did you have short positions? Did you have currencies? Did you have futures? Did you have options? If you did, then that's not a fair assessment. And you'll have a non-normal distribution. You'll have a skewed distribution. So the Sharpe ratio, which uses standard deviation, assumes a normal distribution, would be the inappropriate measure as well. I think you're probably choosing the wrong benchmark. And I would have rather you said active return and active risk, but I don't know that you're using just active risk. How are you measuring your active risk? And are you using active return? And if it's active return, are you investing outside of the Total World Stock Index ETF? TLT is an ETF, but it's not an equity ETF as part of your return from that, whether it be long or short. So I'd first probably look at the components of your return and determine whether or not those ratios are appropriate and whether your benchmark is appropriate. How long do I have to keep this up to safely conclude that I'm good at this? Do I get a medal? Well, you do get a medal, but you'll only figure that out at level 3. It'll tell you where you can redeem your medal. But there is a medal, but I can't say too much more about it. I see you're getting your forward operating earnings from S&P Global Worksheet. I used to, not always. I saw they also have forward operating earnings for 600 and 400. Would you consider monitoring the S&P 600 data and the market outlook? Well, I mean, if you're already getting the S&P 600, what do you need me for on that? I mean, you can figure that one out, right? You can look at where IJR ended, and you can divide it by its forward, by the forward estimate to figure out the multiple. I don't know that that's necessary that I do that. Problem with S&P is from week to week it's not always updated. I'm too poor, unfortunately, and I can't sell my positions. I don't know what that means, but the 5QQQ stock seems to have reversed, and that is very important to note. Remember that those indexes and ETFs that are leveraged can only fall so much before they get okay. When pricing for rate cuts estimated by the market by using Fed funds rate, do you use the contracts through January? You do. Shouldn't you be calculating year end in December? Nope. No, you need a clean month. You need a month in which there are no no meetings. So the number you get for the Fed funds futures, if we're looking at December, the value you get, let's say it's 96.4. You would think, okay, well that's 3.6%, right? But there is a meeting in December. So how this number is calculated at the end is it's all of the expected Fed funds futures for the month. It's the average for the month. Well, if you had a rate cut, you'd have rates up here and rates down here, so that this here would reflect the weighted average of the two different regimes. Whereas January, there is no Fed meeting, so whatever happens in January is a reflection of constant policy. So January would be a better reflection for where December 31st would end, because there is no meeting at that point, so you would use January. Same person did the videos for CSE Vol 1 and 2. I am. What do you think about Mar-a-Lago Accord's effect on Treasury bond? Well, I don't even have to answer that. I can just reject it right away. There is no Mar-a-Lago Accord. It's just one guy's paper, where that's what he called it. He says, what we need is an accord, a currency accord. Let's call it the Mar-a-Lago Accord. Now, he did the right thing by calling it the Mar-a-Lago Accord. If you call it the Atlanta Accord, there's no way it would ever happen. If he called it the Trump Accord, it probably would happen, only because it had the word name Trump on it, and Trump probably wouldn't even need to read it, just saying, let's do it. But it won't happen. Well, I shouldn't say it won't happen. There is no Mar-a-Lago Accord. Will it happen? I don't know. Beats me. Trump may like the idea that there's an accord named after his place, the Mar-a-Lago Accord, and he does want to be remembered through history, so he might just do it for no other reason than it's named the Mar-a-Lago Accord. I don't think he understands what it means, but it doesn't exist. And if you do read this paper, it has a bunch of if statements. Well, if you give me any paper, conclusion, and everyone's saying, oh, look at these conclusions. Yeah, well, if you get to a conclusion through a whole bunch of if statements, it's not a conclusion. It's predicated on all those if statements working out. If other currencies depreciate to offset the tariff is one of the sentences. Well, that's not happening. Right now, that's not happening. So that's gone. If and if and if and if. Well, if all the ifs are not working out, then those conclusions are unsound. So the paper can be dismissed right away just because some of those if statements are not working out. So the conclusion can't be valid. Morgan Stanley CIO mentioned that PE firms are taking private most of the best small cap companies that would have been in the Russell. Well, it is possible. I mean, that is what you would do, right? Take private the good ones. Is the Russell now only a tactical play? Yes, well, it's certainly not strategic, right? I was short 225, 230, 235, 240 on the IWM. Yeah, that was a short. And while I was shorting it, questioned a lot about what are you doing? You're shorting small caps right when interest rates are being cut. Don't you think that that's unwise? Isn't aren't these like I got questioned a lot on that one. But once you get down to 210, 205, and where are we now? 200, doesn't make sense to short it anymore. You've won the war. You're down pushing 20%. You've won the war on that. It didn't belong at 225, 230, 235, 240. It didn't belong there. And yeah, I was right. But I don't think that it belongs back at 170, 180. So I'm long IWM now. If there is any kind of relief rally, IWM will get a lift. But I'll short it again if it gets to go too high, because the narrative still is out there. If you have rates being cut, it favors short cap stocks. So if yields are going to come down and rates get cut, IWM will get a bid that it doesn't deserve. So I am long with a synthetic. So I am long a call and I'm short a put for January 2026 at 201, and I sold a call at 240. So the combination of all this means I got all that for free. In terms of what it cost me in premium, you don't get it for free because of margin, but your T-bills in your account, your cash in your account acts as your margin. So in essence, I got it for free. If it does rally and it goes past 240 by January 2026, I will then be short IWM at 240, which I believe is the right thing to do. So strategically and tactically, I guess I'm positioned okay. That doesn't mean IWM can't go to 190 or 180. That's the risk I run. In your latest video, you dive deep into the economic implications, the proposed reciprocal tariffs set for April 2nd, highlighting how uncertainty is driving market behavior, like the drop in the 1 month yield to 4.28. It's actually 4.38. It was my typo. Surge in reverse repo to 286 as money shifts to safer short-term assets. That is what's going on, yes. They also argue 25% tariffs on autos could eliminate sub $30,000 vehicles in the U.S. It would, due to cost disadvantage and retaliatory trade dynamics. Okay. Given your analysis of supply-demand shifts and the ceteris paribus challenge, how do you see the Fed responding if Q1 GDP tanks further due to the import surges front-running the tariffs? Do you think a diplomatic rollback on Wednesday could stabilize equity? Don't look for the word diplomatic and Trump in the same sentence. Stabilize equity markets enough to reverse S&P's 9.25% drop. I think if there is any kind of relief on Wednesday, it'll just be a relief rally that can be shorted. That would be a great shorting opportunity if there is a rally. I am positioned long for it because it seems to be the least risky place to be. And if I'm wrong, I will quickly switch to a short position. But if there is a rally on this, then I would say that is a trade and not a position. I would not strategically be long the S&P 500 at this point. Yeah. How would the Fed respond? It would cut rates. Do you think that this period of massive imports is part of the lower prices plan? Well, no, the imports aren't going to lower prices. If anything, it'll just raise profitability for those who are importing. If Trump announces 25% tariffs across the board taking effect April 3rd on all autos, what's going to happen on every car lot is the price of autos are going to go up, even the domestic ones, because the import prices, which they're in competition with, have gone up. So why would they ever sell something at such a discount to what the market price is? All the prices will go up. And all the auto companies and dealerships will get extra margin on this one. So all the vehicles they're importing right now, ahead of tariffs will not sell for the pre-tariff price. They will go up in price automatically. Overnight, they will go up in price. So this will not lower prices. It will raise prices. He says, or White House says, they go in effect as soon as they're announced. They'll raise prices. If you're heading to the mall tonight, you'll pay higher prices on certain things. If he calls off the tariffs and saves the day, companies with a surplus of inventory may have to lower prices to get it out. Oh, I see where you're going with that. No, that's a three bank corner shot. Trump is not that. That's not the game he's playing. Again, if this is an outcome, then it's one of those he sunk a ball off the break kind of outcomes. It's certainly wasn't strategic or planned. It's not like he had this great plan saying, you know what we'll do to get the price of cars lower is we'll start a trade war with every single country. We'll announce tariffs across the board. We'll announce tariffs on autos. Companies will force a whole bunch of imports to come in. Then we'll cancel the tariffs and car prices are going to drop because of... No, not one single bit. Not one single bit. Again, in a complex system, if you push one thing, something else moves. But the intention was to push that one thing. The unintended consequence is something else moved. If something else moves that ends up being beneficial, there is a human proclivity to say that was the original intention all along. It is not. It is not. He is not making a three bank corner shot here. He's breaking. And if something sinks, he'll claim victory for that. If something doesn't sink, it's because Obama made the pool table and it was made by radical leftists. And that's why a Republican can't sink a ball on this table. You know, it'll be somebody else's fault. Please, what do you think of the type of analysis? Brussels says to stock up on supplies because there could be potential conflicts. So shares of companies like Costco will increase as they will be seeing an increase in revenue, which will make them more profitable, and good earnings make stock price go up. No. So I see it as just shifting, not increasing what is bought, but just changing the time that it's bought. So here's a 1 year timeline. Let's break it in quarters. And here I am here. And let's say that I buy something each quarter, but I'm told to stock up. So what I do is I buy 2 in this quarter. And when I get to the next quarter, I think, well, you know, if the event doesn't happen, I go, well, I've already got it. So it's just, you'll have higher revenues here, but lower revenues here until you get back to whatever. You're just changing when something is bought, but you're not changing what is bought. If I buy 6 of something, then I have 6 of something. As opposed to buying 1 6 times, I buy 6 one time. Then the next 5 times I go, I don't need to buy that thing. So no, I don't see that as increased revenue. I just see it as shifted revenue. You're just moving it forward, but hollowing out the back end. Will you consider this as a prediction or hope? Not really, since I'm predicting or maybe hoping that the stock price will go up because of increased revenue and profit, and anything else can happen too. I'm predicting that it can go up and anything else can happen too. I would say you're absolutely right. It could go up and anything else could happen too. Yeah, you could make that prediction about anything and you'll be absolutely right all the time. As long as you keep saying, and anything else can happen too. A really beautiful girl is going to come knock at my door in 10 minutes. And anything else can happen too. So in 10 minutes, I'll say, see, told you. If she doesn't knock on my door. Because anything else happened as well. I could say, see, told you. So yeah. I don't know if you intended that to be funny, but that is kind of funny. You once said not to read trading books. Well, what about books like Options, Volatility, and Pricing by Sheldon Natenberg? Yes, absolutely read those. Those approach more of a textbook type of flavor because he's not telling you in there, hey, I figured out a trading strategy and I'm going to tell you what it is. He's saying, if you're going to trade options, you better know this stuff. Right? And so it's a lot of the math behind the options. Yeah, if you can understand that book, you have a good understanding of options. But nowhere in there does he say, here's my secret sauce. This has made me millions. Now I'm going to sell it to you. Like those kind of books you want to avoid. I love that we are now at the point where we're trying to rationalize the tariff plan. Are we trying to rationalize it? Imagine if Kamala or Biden did this. Did what? The tariffs? Is that a dig at me? I would be just as critical. I would say they're just as boneheaded and just as stupid if they were doing the same thing. I'm not rational. I don't think I'm rationalizing the tariff plan. There is a guy who is threatening tariffs. I'm not making it up. He's in the news every day. And our job is to figure out, well, what does it mean? What's it going to do? If you listen to Peter Navarro, well, please don't listen to Peter Navarro. It's one of the biggest idiots in economics is Peter Navarro. I think it is clear that you think Peter Navarro's a they? They, them? Do you mean it like that? They, them? I don't think he's a they, them. I think it's clear that he doesn't understand these things. Well, no, he doesn't. That's exactly it. Peter Navarro doesn't understand these things. He's got a very first-year textbook understanding of economics, and he doesn't understand ceteris paribus. He doesn't understand that, wait, hang on a second here. That's if nothing else changes. And he doesn't understand that the economy is a complex system. He doesn't have an understanding of complexity theory. As an economist, you'd think that'd be one of the first things you'd understand. No, this guy's an idiot. Doesn't understand these things, and he is taking a pleasure in the chaos. I think he's an ex-con as well, right? He talks about bringing jobs back, but doesn't realize how the world has changed. That's true. Not only that. Here's the statement he made about the tariffs. He says this is one of the biggest tax cuts Americans will see. He thinks it's a tax cut. He thinks it's a tax cut. He is an idiot, a pure idiot. If he wants Americans to weld and bolt car doors, that's fine, but he will find they will no longer have jobs welding and bolting gas turbines. I think what you're saying here is that you can create some jobs in one place, but you're just going to lose them in another place. Yeah, I would not be listening to Peter Navarro for any kind of sensibility whatsoever at all. This guy hates certain things, and that's it. And I can give you one guess as to which country he hates the most. RRP increase because end of quarter. That would be Monday would have been end of quarter. Did you just give an economic model for Tesla to grab more market share? No, I did not. Tesla fans. Everything is bullish for a Tesla fan, right? Tesla is going to be reporting their quarterly numbers, their sales today. I'm sure no matter how bad the number is, Dan Ives will come out and say this is bullish for Tesla, and the Teslites will say this is bullish. And some will even say it's not a car company. It's not a car company. But it'll be bullish. No matter what happens, it's bullish. No, I did not give an economic model for Tesla to grab more market share. But, if that's what you see. All this talk about certainty reminds me of the TV show Billions, where investments would be made on the basis of certainty by way of illegal acts. He would be asked by the owner of hedge fund, are you certain? He would reply, I'm not uncertain. So when has any investment in common stock been a certainty? And if there is such a trade, one would bet their entire account. I don't understand your question here. As it is now for many years, a 2% investment of TLA is all one should ever risk because it's always uncertain. I don't understand what that is. There's no, you don't know. On any price, you don't know. You don't know what's going to happen today or tomorrow. You don't know. You seek information, right? You understand the industry the company operates in. You understand the company. You seek access to management. If you're on the buy side and you're controlling investment funds, you can call the company reach out to investor relations, say, I have questions for management. You can get a meeting and you can ask your questions. You can do site visits. There's a whole bunch of stuff you can do to get as much information as you possibly can, which increases your level of comfort with the investment. But you'll never be 100% certain. That's not a drawback of finance. That is a constant and a feature of life. That's just life. Period. If you want certainty, go into sciences, go into biology, chemistry, physics. There is certainty. Mathematics, you have certainty. But if you're going to deal with any system in which people are involved, you can put certainty aside. 100% you could put that aside. Now, while you may not have certainty, you can be somewhat certain of certain outcomes. The log normal distribution of returns is a fairly good representation of what we can expect in the return series or return distribution of an asset, so that we can say with some precision that 70% of the time we would expect that stock would either go up or down by less than one standard deviation. So we do have some idea, some kind of framework in which we can think about how we measure this stuff. And then from there, you can construct option strategies that then take advantage of certain parts of the distribution. So if you understand how uncertainty is translated into volatility and how you can carve up that volatility, you can minimize the impact of that on you. What you cannot minimize is the exogenous unforeseen events. A tornado touches down and you don't know how long it's going to be on the ground for, how much damage it's going to do, how much of the economy it's going to put out of commission. It could be a super tornado that really disrupts a lot. This you do not know. That is true uncertainty. Is you can't even measure the volatility associated with that. But with stocks you can. You can tame the uncertainty to some degree. But as far as am I buying a winner, you can have you need four things. You need some education. You got to know something about what you're buying. You need some framework in which you can then begin to evaluate what you're buying, and you're going to need some training. And well, what is it that I need to know? You're going to need some experience and a healthy dose of intuition. And from all of this, you can then say, I think this investment sounds good. Now, that doesn't mean there's no risk in that investment. It just means you're aware of the risks. But if you want a return, you're going to have to take on risk. No risk, no return. What is the fourth thing that you need once you make this investment? Risk management. Right? There's going to be risk. That is the source of my return, but risk is two-sided. It can go in two different directions. I want this risk, but I don't want that risk. So if you start seeing this, number four, you better understand how to employ risk management strategies. So through the proper education and through the proper experience, you will develop intuition over time that helps you evaluate an investment. And since there is risk, that is the source of your return. Since it can be two-sided, you better understand risk management. There's your career. That's it. U.S. car market and auto tariffs will devastate the already terrible cheap car market in the U.S. True. Looking at the brands, domestic brands don't make cheap cars. That's true. Foreigners only. Chevy's making a cheap car. It's usually a rebadge job. No small cars on sale. Not as small as Europe. That's true. Only because the U.S. is really, and North America really is a different market. Much wider streets, much more space, much bigger houses with garages. Europe was built hundreds, thousands. You can go back 1,000 years for some cities. So the city planning isn't the way that you would have it in North America, where you have relatively new suburbs that can be built with wide streets, big driveways, double and triple car garages, lots of space. That doesn't exist in Europe to the extent that you'd get in North America. Not to mention car loans being expensive as they are, the dealership model being predatory with markups and extras. True, cars are already unaffordable, way too expensive. This is only going to get price more people out. True. Used car salesmen cannot wait for those tariffs to arrive. That's true. They will shift more inventory and they will hike their prices. They immediately, exactly. So why not do price hikes, right? Yep. In a very twisted way, this is one of the most effective ways to contribute to lowering emissions. That could be an unintended consequence, is that you've destroyed the car industry and priced the vehicles so high that you reduce the amount of vehicles sold each year, which reduces emissions. You could say, well, at least we have that, but I would not attribute that to what is going on. That's just an outcome. Mexican auto production actually keeps vehicles affordable for American consumers and provides crucial production scale for automakers. Why is the administration targeting Mexico? Because you have zero execution ability. You have a generally unknowledgeable, is that a word? An uninformed and a general lack of knowledge from this administration. This is rookie hour. I don't think you have anybody that truly understands what they're doing. I think they say, that's a good policy, let's ram it through. Here's how we're going to do it. And doing it in the worst possible way that you can imagine. They just don't know what they're doing, period. That's why they're doing it. They don't know what they're doing. Is this primarily political posturing? Political ineptitude? Or is there a genuine economic strategy at play? Nope. That might outweigh the negative consequences. Nope. Well, the economic strategy is let's try to rebalance trade. The way that they're doing it is absolutely asinine. So the negative consequences will definitely outweigh the positive consequences. Seems particularly counterproductive to disrupt this manufacturing relationship when it appears to benefit American consumers through lower prices. True. And American companies through viable production economies. True. I agree with all of that. You're right. If you're puzzled by why they would pursue this policy, you can say there must be some greater strategy here I don't understand, or these people don't understand anything. My model, it's these people don't understand anything. There is no greater strategy. They're not smart enough for that greater strategy. What's the difference between volatility and uncertainty? I've already explained that. I think you're too optimistic with your market outlook and underestimate the effect of tariffs. I'm underestimating the effect? No, not at all. I'm not too optimistic. Not at all. If anything, you would say I think you would say you're too pessimistic, unless that's what you mean. I'm not pessimistic enough. Isolation when attacking free trade. This feels like 2022. I think a bear market. Oh, so you think that as negative as I am, you think I'm not negative enough, that I'm still too optimistic. Okay, I can see that. America's average brand car purchase tag is already 50. That's an average. Be careful about an average. And I don't know where you got the 50 from. I don't know if you're using the word right. I'm just going to take your word that you say that's an average. You shouldn't be using an average. You should be using a median, not an average, but a median. Small and cheap cars are already priced out of the market. Americans can't afford it anymore. This will only make it worse. U.S. is going into a huge recession. You say there will be no uncertainty left, only volatility. But is the volatility not a direct result of the uncertainty? And let's take away... the difference between the two is when I say I have uncertainty, it's because you don't know what you're going to measure. You don't know what the outcome is, and you don't even know how to measure the outcome. With volatility, volatility is because the price movement from day to day is uncertain, but I at least know how to measure it. And the best measure is how it has historically moved. Usually volatilities tend to be fairly stable over time. So if I see a price, and it doesn't matter which way the price goes, but you see a price moving, you see price charts like this all the time, right? I mean, they never just go in one direction, but you tend to have them moving in a particular direction. You can say, well, this is the trend, right, that I see going on. Well, all of this around here is volatility. That is the day-to-day uncertainty as to where the price is moving. Well, you can measure that. And you can come up with a distribution of returns, of daily returns. You can have some distribution, and if you take the price today over the price yesterday, and you take the natural log of that, you can get a return series that approaches a normal distribution. And if it does, we know that 68.7% of the time, the move will be within one standard deviation of the mean return, and the mean return would be, well, whatever this trajectory happens to be. So you can mathematically approach something, not of certainty, but of the measurement of the uncertainty. But there are some things in which an event or something may happen in which you're uncertain about when it's going to happen, uncertain as to what it is going to be, so you have nothing to measure. And when you cannot measure it, you can't price it. That's true uncertainty. But the uncertainty you get with price movement, there are frameworks within which you can measure and price that level of uncertainty. That is then called volatility. But with Trump, it induces volatility, it increases volatility everywhere, but he is a source of uncertainty because you don't even know what it is that you need to measure until it actually happens. Once he announces what's going on, that's not going to be good. Let's say he announces 20% tariffs across the board. That's not going to be good, but it will cause asset prices to change, and we can begin to capture the volatility of those changes and begin to price in that level of uncertainty. That is called risk. When you can measure and price the uncertainty, you now have risk. And risk can be packaged and sold. You can buy risk, you can sell risk. That doesn't necessarily mean that the markets are going to go up. Markets could go down with certainty. To continue on using words in a confusing way. Well-explained tariffs, they reduce living standards for everyone. True. The only way they work is if certain targeted countries become so starved of US dollars that they are forced to negotiate terms with the US. So they may work as a coercive measure. The countries that would become starved of US dollars would most likely be emerging markets. I really doubt that they have trade surpluses with the US. I don't know that they would. And if they really need US dollars, they're more likely than not to have trade deficits. The USA prints money for its consumers. The Chinese government prints money for its exporters. So the money flows to China. This is the Triffin dilemma. U.S. could stop all its internal socialism, subsidizing the U.S. consumer. Okay. I'm going to pass on that one. Can I make a controversial comment? The U.S. Americans should buy less new cars? Yeah, probably. Average person trades their cars every 3 years, means a luxury purchase most of the time. People buy new cars because they want one, not need one. Well, that describes most consumption. If you go to the mall, it's just a lot of people buying stuff they don't need. It's buying stuff they want. Right? You can, if you need something, I don't have to advertise to you. You're going to find your way to me because you need it. But if you want something, well, then I have to influence you somehow into buying it. I have to demonstrate that this is not just a want, but you need this now. How can you not own this shirt with this logo if your friends have this shirt with this logo? And look at the girls they have. Don't you want a girl like that? Well, get a shirt with this logo and you'll have that. I mean, I've got to use advertising to persuade you that your needs are wants. I mean, that you can say that with almost everything that is purchased. However, if everyone just bought what they needed, there would be almost no economy, really. The level of poverty and unemployment would be astronomical. So you have to keep this going, right? You have to keep the whole process going. People making stuff that other people don't need, people buying stuff they don't need because they want it, people throwing it out, and you got to keep all of that going. And then you can have a good standard of living. But yeah, it is based on production and consumption. Production and consumption. You can't stop them. And then when you get to the bottom here, these comments are just not worth going through. So that's the end of that.